Some people jealous me. After all, the person who is about to tell you about American taxes is in Nigeria. That's our new world.
Wow.
It's a global village now. That global village is now that we're really realizing it.
Yes, so how you doing today, Ms. Bose?
I'm good. How are you?
Good. Thanks for doing this.
You're very welcome.
Okay,
thank you for having me.
Let me not come and embarrass my cousin here. See my cousin, though.
Thank you, Uncle Kayode. Thank you so much. Not embarrassing me at all.
Our cousin is filing all our taxes. Okay,
how's everyone doing?
All right.
Very well. Thank you. Thank you for giving us this presentation today.
I got you there. How you doing now?
I did hear, sir.
I've not seen you like almost 30 years now.
No vex. So we'll go see very soon by God's grace.
Even Tunde saw me before you.
I know. That put me in a bad situation.
You were the worst situation. You were bad before. The worst.
How's the family, sir?
We give God the glory, my brother.
Yes, sir.
Bose, I wasn't sure. Did you attend Air Force Secondary School?
No.
Okay, so
no, Beatrice did.
Okay, only
Beatrice.
Okay.
Yeah, Beatrice did.
All right, I wasn't sure.
So, Boss, this question I beg before we start. So, this one that you're in Nigeria now, your trip to Nigeria, is it an expense?
No. No, it's definitely not.
Anyway,
most definitely not.
But if you're a business owner, it could be now.
It can't be because I came here for family reasons. So I cannot take that and say it's now a business expense. No, I can't do that. I mean, I work from here now because I've been here since February, but yeah, I still can't take it as an expense.
What if
the reason why I came here was different?
What if you did business alongside the time when you were taking that family break? How does that work?
No, because all I'm doing right now is I'm working from here, right? So, I mean, even Wi-Fi, all the expenses, it's not my money. I'm not spending a dime. So I can't come and claim, I can't come and claim it on my tax return. And plus, I still have the expenses back home for where it's based. So that's what I can still claim.
Oh, okay. So you can't double dip, basically.
No, I cannot.
Okay.
I cannot.
Okay.
Can we start asking questions or just wait? Hello? Can you hear me?
Yeah, we can.
Yeah, I can hear you.
Oh, yeah. Do we start asking questions now or we just wait?
I mean,
I think
usually
we're just going to give a few more minutes for people to join in before we get started. So this is just offline conversations first.
Okay, so Bose, let me ask you real quick. I have this startup business we started last year, me and my wife, and we've actually invested so much into it, but for our private and personal money. We have receipts, but not in the business name. Can we file taxes this year with that name? Business name?
But you still have, so you have the receipts, but you use part of your own money, right?
All of our own money. Before we opened an account for the business, we're using our cards and money. So now we're trying to expense everything into that business. And we've never filed with it. It started last year or 2 years ago, actually. So I'm thinking it's time we start, expensing it on the business.
Okay, so you know that you can only claim whatever you have based on the current year, on that current tax year. You can't go back only if you choose to amend your taxes for prior year, that you can do so. So, but yes, you can claim the expenses as long as they're related to the business, definitely. One thing I always try to tell people though is that it's best that you actually do everything the right way. So basically, when I say the right way, set up your company name. I mean, you can also be a sole proprietor if you want to stay as a sole proprietor. You know what I mean? But it's always best to set up a company, set it up as an LLC for starters, because that way LLC is a limited liability company. So you're able to limit yourself from any liability that can come your way, basically. So you don't want to get involved in, say there's an issue and you're basically only, you're a sole proprietor. So now, and you have a home, right? If let's assume you're not an LLC and they sue you, they can go after your home. So it's always best setting up an LLC for your business is always a better way, because at least that way you can
an LLC.
prevent.
It's an LLC working off a basement. However, we've done some good things off it. We've actually been inspected by states and everything. So, and it's cost us a lot of money. So now we're trying to expense it to the company rather than off ourselves. So it's an LLC, certified and registered. So I guess I will be back to you for filings this year.
Okay.
Okay, you see, our cousin is helping us.
We'll send you the quotes soon.
No, it's our cousin. I mind your business. Yeah.
It's our cousin now.
Our cousin.
Okay.
Cyril.
Good afternoon. I get one question for your cousin.
I know they call her my cousin now our speaker.
Okay, sorry. Now my cousin, Cyril, come through me. She's my cousin.
So if I know you say you're actually working from Nigeria now, and you can claim whatever you have the expenses on your taxes. Assuming if you go can you put that as a conference trip and then claim that on your taxes, or you're not allowed to put that as a conference trip and claim them on the taxes? That's one. And then my second question would be, I know we haven't started yet. I'm just going to listen in, and then I will contact you later. How to start up an LLC, because we're looking into starting up an LLC, and the difference between the S Corp and the C Corp, which will be better for us. I am my wife, so that's one of my main questions I would like clarification on.
Okay, so I'm gonna say no to C Corp, and my reason is that you get taxed twice.
Okay.
I never recommend anyone starting a business to set up as a C corporation, because you always get taxed twice. You're getting taxed on the profit you made, then you're getting taxed on the income as well. So you don't want to do that. Usually an S Corp is better, and you only get taxed once. So if you weigh, you always have to weigh your pros and cons. Do you want to get taxed twice, or do you want to get taxed once? Once I think is better. So, I would always, whenever I'm speaking to clients, I always tell them you're better off going with an S Corp. And usually everything is always based on the business that you have, what type of business. But for the most part, S Corps are usually, you only get taxed once, and that's a safer route to go, because you don't want to be spending too much, you don't want to be paying too much in taxes, period, So the less you have to spend on taxes, the better. And S Corp is always a better route when it comes to that. That's the only difference between an S Corp and a C Corp is the tax liability. Hello?
Yeah, at this point, okay, I think you should introduce the person and let's start. We can't wait anymore.
Yeah, I think we should get started now. Gake, over to you if you can hear us.
All right. Bose, it's not because you're my cousin that they are saying Ogake over to you. It's just I'm the one who usually introduces everybody.
I understand. I didn't think so.
All right, so let's see, how many people do we have here? Okay. All right, so let me pull up your long credential at the combo. All right, so let's see if I can get this right. All right, so welcome, ladies and gentlemen. Welcome to this session about taxes and everything that relates to taxes. Hopefully, you will leave the space more enlightened and probably with some more cash in your pocket at the end of this, or know how to get more cash in your pocket. Today, we have a very special person, very special to me. She's my cousin. She's my sister. And she is a professional when it comes to anything taxes. Her name is Bosede Atobatele-Adebanjo, and she's the founder of Bose Tax Accounting, LLC. She's a certified public accounting, she's a certified public accountant, I think. And I think that was just written wrong here, CPA, I think. I don't know if that's the correct way it's called, but she has a firm in Perth Amboy in New Jersey. And Bosede is an innovative and driven tax accounting professional with extensive and broad knowledge that spans over 18 years. So this experience actually has enabled her to provide an array of services from complex or simple business formation all the way to accounting and bookkeeping services and tax preparations. Bosede is a member of the American Institute of Certified Public Accountants, the AICPA. She's also a member of the New Jersey Society of Public Accountants, NJCPA. And she's also a member of the College of Staten Island Alumni Association. So please, we want to welcome our speaker of the day, Bose Atobatele. Thank you very much for accepting to do this for us within a very short period of just asking. So we really appreciate you. Thank you.
And I want to say a big thank you for having me. It's my pleasure to come on board and speak today. So I'm very excited to be here. Thank you. So I'm just going to start with saying Bose Tax Accounting, LLC. I mean, we're a full service accounting firm and we're for people in the business. Basically, our current mission, our mission is to deliver professional, affordable, and accurate services to people and businesses. What we do, Bose Tax offers a range of services, and like my cousin said, business services, tax services, and accounting services. Hence the name BTA services. Okay, so I want to start by welcoming you all to the craziness that we call the 2020 tax filing season. Okay, so because the IRS is still playing catch up, right, from last year, in addition to the new tax laws passed in the middle of this year's tax filing season. So April 15th, that was the individual tax return deadline, has been moved to May 17th, okay? And like I said, that's because the IRS is backlogged and also they passed a new tax law. So right now, our new tax filing deadline for individual taxes is May 17th, okay? So moving on to the need, what's our need? Okay, you're not required to basically file a tax return, right? If your 2020 income did not equal or exceed your standard deduction. Basically, let's say you also don't owe any special taxes, and special taxes could be like foreign earned income and stuff like that. Basically, what I'm trying to say is you only need to file your tax return if your income is higher than your standard deductions, right? And basically also if you're under the age of 65. The only time that your age doesn't matter is if you're married filing separately, then you only have a $5 limit. You have to file your taxes. So what are, let's say, the common taxpayer filing challenges, right? We have here like incorrect W-2s. So one thing, everyone, if you are a salaried employee, you have to ensure that your W-2s are correct. Because if they're not, you end up having to amend your tax return. You would need to get a corrected W-2 from your employer and then have to amend it again, right? And so you don't want to do that because then it's costly to you. If you don't have all of the documents, that's fine. You don't have to file it right away. You don't have to meet the deadline. All you have to do is file for an extension, and that extension will give you till October 15th to file your taxes, right? So it's better that you don't file right away if you know that you don't have all your documents in place. Because then if you file, you don't want the IRS coming after you saying that you missed this, you know, and it's a substantial amount of money, then you get the additional penalties and interest that may, you know, come from filing an inaccurate tax return. So we also have some people, part of the challenges they face is also they owe the IRS. So if you owe the IRS, call the IRS, talk to them and set up a payment plan. Because one thing you don't want is for the IRS to garnish your wages, because they will eventually, if they can't come to an agreement with you, they will go after your assets, and you don't want that. If you don't know what you're doing, don't do your taxes. Have a professional do it for you, because at the end of the day, you don't want it to be that you made a mistake. Mistakes sometimes can be costly as well, right? For instance, also filing status. Let's talk about the filing status. Some people are sometimes not sure if they should file single, or if they should file maybe married filing separately, or if they should file as like a head of household. If you're married, you know, then you know, okay, married filing jointly, unless, you know, you guys don't want to file together, then you know it has to be married filing separately. If you're single, then you know it's single. But if you have kids, then you can file as a head of household, even if you're not married. In some situations, you could have, for instance, where a couple are married, but they don't live together, or, you know, like they don't live together, and basically maybe the husband has he pays all the bills and whatnot, and the wife has been out of the country for over 6 months. If they choose to, the husband can file as a head of household. And they're no longer going to be coming back together as man and wife. So basically, the filing status can be changed, right? So sometimes different situations you could change your filing status, as long if you're not married and if you're married and you're separated, you can definitely file head of household, especially if you handle the entire cost, you know, and your spouse is maybe not living, as long as the spouse also is not living in the same address as you are. Okay. Then we have another challenge would be the new tax laws, which we'll get to as well in a couple of slides. So these are common taxpayer filing challenges that they do come across. And so with that said, I'm going to move on to the next slide. So we're going to talk about the new tax breaks, right? And how they are going to benefit millions, or they're supposed to benefit millions. So here's what you need to know, right? The recently passed, that's the American Rescue Plan Act. It contains several tax breaks that you and your family can, you know, can take. So we have some major provisions of the bill that could definitely mean more money in your pocket, especially during this current year. How? So let's talk about the child tax credit. So the CTC, right, that's child tax credit for 2021 increases from $2,000 to $3,000 for kids, right? And these are kids ages 6 to 17. And $3,600, $3,600 for kids 5 and under. So but in order to receive the full tax credit, your adjusted gross income must be under $75,000 if you're single, $150,000 if you're filing a joint tax return. And then if you're head of household, that's about $112,500, right? Just keep in mind that if your income is above that threshold, you can still receive $2,000. That would be $2,000 per child as long as your income is less than 200,000, regardless of your filing status, like if you're single, head of household. But if you're married filing joint, it can be your filing, your income can be up to $400,000, and you still end up with, you know, $2,000 per child. From the new law, basically, you can receive up to 50% of your the 2021 child tax credit. And that's going to be coming in like 6 monthly installments. And that starts, I believe, in July of this year. So from what I understand, what the IRS is basically saying about that is that there may be some delays. Okay, so that's to be expected because, you know, they may have to input this this is a whole new thing that they're doing. So basically, obviously, there will be some hiccups along the way. So there might be some delays in that. So let's talk about the child and dependent care credit. We have, if you and your spouse and you guys have children, right? And they're in daycare, or you have an adult that you care for, you know, an aged parent, then you may be eligible for a larger tax break in 2021, right? Now, let's say you can now spend, I believe now you spend up to $8,000 in dependent care expenses for one qualifying dependent, and then you get a 50% tax credit. So the result ends up being a maximum credit of $4,000. That went up by about 1,050. If I'm on point, it's about 1,050 that it went up by, right? But if you have, let's say, more than one household, more than one qualifying dependent, right? And you can spend up to like $16,000 in dependent care expenses and get a 50% credit. So this will give you a maximum credit of basically $8,000, and that went up from $2,100. So that's a substantial, you know, that's a good credit. But you have to qualify to get that, of course. Just keep in mind, to receive the full tax credit, right, your adjusted gross income cannot exceed $125,000. That's a caveat. And your dependents can include people of all ages. It's not just for kids, as long as they meet the dependent qualifications. Okay. So on to earned income tax credits. If you are a household with no kids, then just think about this: no kids, then, and you qualify for the earned income credit, the maximum credit that you get, it went up from like $543 to $1,502. So that's almost $1,000 increase. Hello, can everyone still hear me? I'm getting a notification that my internet is unstable. That internet connection is unstable.
I can hear you.
Can everyone still hear me?
Oh, we can hear you.
Okay.
You're okay.
Okay. All right. Thank you. So because of this change, right, you have more taxpayers that are qualifying for this credit, right? The lower age limit for receiving the credit decreased from age 25 to age 19, right? But the upper limit of 65 for receiving the credit is eliminated. So there is no upper age limit for 2021. So you can be over the age 65 and still get a credit for that. But you can use either your 2019 or your 2019 income or your 2020 income when calculating your credit to get your your maximum credit. You can use that income to determine what your credit would be. Okay. So if anyone is living in the States, you either got the stimulus check or you didn't. So if you were one of those people that basically filed your tax return and mailed it in, then you most likely did not get your stimulus check. But when you do file your 2020 tax return, that should be remedied. So if you're entitled to get the $1,200, the $600, and then the $1,400, then it's a big payday coming your way. So basically, the third round of stimulus checks, right? That was for $1,400. That should have already been sent to a lot of taxpayers. I know that some people have not received it. The payment, however, phases out. There's a difference based on what we were, what was done prior to now. Now your income, if your income is over 75,000 for single taxpayers, it phases out. For head of household, it has to be 112,500 before it phases out. And then for married couples, it has to be over $150,000 before it phases out. So if you're in that threshold, if you're under that amount, then you should see the full amount coming your way. What are the actions to take, right? Look for updates on the advanced payments for the child tax credit, right? So the IRS basically is still sorting out how to get half of the child tax credit to you in 2021. That's still the issue. That by the time July, sometime before the end of June, I'm sure we'd already have an idea of exactly what's going on. If that's going to be happening on, if that's going to definitely happen in July, or if that's going to be pushed forward a little bit. I believe it should still take place, but then because the IRS is backlogged, we can't, we have to just wait and see at this point. Then also, another action to take with the child and dependent care credit, right, is to consider increasing dependent care expenses, right? Try to look ahead to the rest of 2021. Consider if you should increase your dependent care expenses to take advantage of the significant increase in this credit. So remember, I had said earlier that you could get about $8,000 in credit. So it would always be good, you could always take advantage of that. If you have a qualifying dependent, you could spend up to $16,000 in dependent care expenses and get a 50% credit. So that gives you basically a maximum credit of $8,000. So you could spend up to $16,000 if you wanted to. So that's another way of looking at it, increases dependent care expenses to get 50% credit back, okay? So with regards to conducting to the earned income tax credit, conduct a tax forecast, right? You have this dramatic increase, right, in the tax credits. So you may want to estimate what next year's tax bill is going to be. You may, it may make sense for you to adjust your withholdings to account for a lower tax obligation. So at least that way, you just have to determine, you have to play around. There's always there's sites online that you can go to and put in your income and try to play around with it and see if you contribute into 401k, you add that in as well as an option. There's so many things that you can do. So that way you can actually predict what your liability is going to be, or what credit you can get back and stuff like that. So be conservative when forecasting your earned income tax credit, right? It is kind of somewhat uncertain how the expanded earned income tax credit will impact those over 65, especially when you have no children, right? So for example, are Social Security benefits considered earned income when calculating the earned income tax credit? And does the larger standard deduction for those over 65 affect the earned income tax credit calculation? So stuff like that, we don't have any further clarification that's issued by the IRS. We may try to want to be, conservative about the credit amount that we may or may not receive. Okay. Okay. So moving forward to, sorry, I skipped. Late tax legislation creating havoc, right? So remember I said earlier that from April 15th, it was moved to May 17th, right? New tax deadline, May 17th, okay. So with Congress, with their recent move, they said they were going to be retroactive. They were going to make a portion of the 2020, unemployment tax, income tax, they were going to make it tax-free, right? But by doing so, it had to have been no more than 10,200 for each individual that got the money, that got an employment from the state. So basically, you get this income, the unemployment income, tax-free. $10,200, the first $10,200 is tax-free. But this wasn't implemented till this year. This wasn't implemented till the third month, with basically just as a recent. So this was part of the havoc that presented itself, and they only came up with this just because of the whole pandemic situation, and they're trying to make things easier on people, right? So anyways, because this new law of 2021, right? 3 months after the end of the tax year, and after millions of Americans have already filed their tax returns. So basically, this came into play 3 months after the end of the tax year, after millions of I am so sorry, I do apologize.
No, we all work from home and have kids. That's okay. Let my daughter play.
Yeah, that's my 3-year-old. I apologize. Yes, I know. We're all working from home, but sometimes, they see you and they want to be around you. Anyways, moving forward. So let's try to understand the situation, right? If you've already filed your 2020 tax return, it's fine. And if you got if you already filed your 2020 tax return and you did not, the 10,200, you were taxed on it, it's fine. It's all good because the IRS will actually make the changes themselves, okay? So they will adjust the returns. So people, if you filed already, you don't have to amend your tax return. That's the good news. No amendment is needed. If you have not filed your 2020 tax return, you have to, then obviously you have to make sure that you deduct, you include your income, you include the unemployment income there. If you're using a software, it should automatically calculate it. If you're using a tax preparer, the tax preparer should be able to, adjust for that as well. Also, tax deadline has been moved. And like I said before, because of all the havoc, that's why it was moved from April 15th which is now to May 17th. Again, if you're going to file for an extension, make sure to file it by the deadline by May 17th and file for an extension. And that way you have up to October 15th to submit your 1040s. Also, just a reminder, first quarter, for some people, they do actually pay an estimated tax payments on a quarterly basis. The first quarter estimated tax is still due on April 15th. It's not May 17th. So first quarter tax payments, estimated tax payments are still due on April 15th, okay? I'm sure if there are any additional insights, I know that there will be additional, publications from the IRS released if there are any changes to the tax laws currently. So let's talk about the income, right? Income the IRS cannot touch. So it's always good, to have that source of income that, whatever you do, the IRS will not touch, will not tax it, it's non-taxable to the IRS. So that's good news, right? So we'll start with tax-free interest, for instance. And that Okay, so tax-free interest, basically when we talk about tax-free interest, we're talking about municipal bond interest, right? The federal government does not tax municipal bond interest. So these bonds are basically issued by a state or municipality, and the tax-free benefit increases the higher your income. But this is where one must take caution, because you have to ensure that that underlying municipality is not in dire financial conditions right now. And, especially with the way things are right now, I think, some municipalities are in dire financial conditions. So you want to make sure that if you do buy these type of municipality bonds, that the municipality itself is okay, it's financially stable. Okay, so let's move on to number 2 on the list, which is health insurance premiums. Most health insurance premiums are tax-free for now. Okay, this could change in the future, and this definitely could change in the future, and to help pay for healthcare reform, but for most people, this benefit can be paid using pre-tax dollars. Then we have the income from Roth IRA and Roth 401k accounts. The beauty of this is that while the income, the amount that's contributed into this particular IRA, into these accounts, the Roth IRA and the Roth 401k accounts, the income itself are taxed, right? The income is taxed, but any earnings made on the contributions are tax-free for federal income tax purposes, as long as the holding period and distribution rules are followed. But just remember, it's tax-free. As long, but the contribution is not, because you get taxed. This is money. This is, okay, say you've gotten your income, you've paid taxes on that income that you earned at work, and you got paid your salary, it was put into your bank account, deposited into your bank account by your company, right? That money, you now say, I'm going to take a certain amount of this money and put it into a Roth IRA or Roth 401k. Guess what? You've already paid the taxes on this contribution, the initial contribution. You've already paid the taxes on it. So the earnings you get from it is tax-free. Okay. Then let's talk about the health savings accounts. Contributions. The beauty about this one is that you can contribute, your contributions are deductible and your earnings are tax-free, right? As long as you use the disbursements are used for healthcare expenses, for qualified healthcare expenses, it's tax-free. Child support. Child support income, the income you receive is free from federal tax. You don't pay any taxes on that. So for some individuals, if you carpool, right? Not sure if that's still going on lately, but carpool revenue, right? So some individuals do, they carpool to work, right? Excuse me. If you carpool and let's say you have expenses, right? The commuting expenses, they're not deductible. They're not, generally, that's not deductible. But if, let's say, your colleague, the person, that you're riding with decides to reimburse you, to give you some money back, then that's not reportable as an income. That's just, additional money for you to spend. Home sale gains. Home sale gains. The beauty about that is that up to $250,000, okay, if you're single, $500,000 if you're married filing jointly. That's of capital gains on a sale of your principal residence can be tax-free. Okay, so it's always, things like this. If you're planning on selling your home, always, how long have I lived in this house, but you have to have lived in it for a number of years for you to qualify for this. And the beauty about it is that if it's your primary residence, even if it's not your primary residence, but it was at some point in time, and it's a rental now, you can still claim. You can still get the gains off of this. So that's the beauty of that of this income. Also, when we talk about up to 14 days of rental income, so if you own a home or a vacation home and you say, oh, I'm just gonna rent it out for, I'm traveling, I'm gonna use Airbnb and rent it out for 14 days, as long as it's no more than 14 days, you don't have to be taxed on it. It's not taxable income. But if it's over 14 days, you do have to pay taxes on it, okay? And that will be reported on a Schedule E, which will be filed along with your 1040, okay? So then you have the certain employer compensations, that's in addition to the healthcare premiums. There are a number of employee benefits that are not taxable, right? All have limits, but every tax-free dollar is literally money in your pocket. And these, like the airline miles, earned on business credit card expenses, the certain employee provided tuition expenses, the qualified adoption expense reimbursement, and even up to $50,000 in employer paid term life insurance. You have the FSAs for dependent care and health care. And then you also have the commuting expense benefits, for parking and for mass transit for commuting. Those are income that IRS can't touch. Basically, just remember that when you pay for something in pre-tax dollars, when you pay for something in pre-tax dollars, it's like you're giving yourself a raise, because basically you're not taxed on, you're not getting taxed on it. And that's what these are. You're not getting taxed on these particular expenses. So that's the beauty of that. Okay, so let's talk about like tax return review hints, right? What you should do prior to e-filing your tax return, what you need to review. What are the basics? Let's just confirm the basics, right? The basics for you, for your spouse, your dependents, you have to double check the name, the address, the social security numbers, and make sure that there's proper identification of dependents that are under age 17, right? You have to double check your filing status. Are you definitely married, filing jointly, married filing separately, head of household, single, whatever it is, you have to make sure that that's correct, okay? Also, you have to confirm your income amount. So basically, when you're trying to confirm your income amount, I would suggest you start with your total income line, right? Does the amount seem reasonable? Like I said, again, that goes back to your W-2. Is your W-2 correct? For instance, did you earn more than what's reported on your W-2? If it's, let's say your earnings was 100,000, and then you notice, wait a second, they only said I earned 50,000. You already know that's incorrect. It's advisable for you to definitely contact your employer, have them send you a corrected W-2, which would be a W-2C. So basically have them send you a corrected W-2 and file using the corrected W-2, okay? Adjusted gross income, right? Most tax returns basically will not have many lines entered in this area, but some might need special attention. We have the educators, you look for your classroom expense deductions, right? Self-employed, look for your deductible self-employment tax. Then you have the contributors, you check for your HSA, which is your health savings account contributions and retirement plan contributions. If you're a student, you're checking for your loan interest, the student loan interest that, that's deductible on your 1040. If you're divorced, check for accuracy, make sure that the alimony or the child support claims that they definitely apply to you, right? So those are some of the things that you should be looking for. Under taxes and credits, you'll be looking at your deductions. Take a mental note, whether you're taking the standard deduction or you're taking the itemized deduction approach, right? If standard, do the math. Okay, if I'm single, it's 12,400. What's my Schedule A like? Is my Schedule A, which is for itemized deduction, is that lower or higher If it's lower, you want to definitely go with the standard deduction. If it's higher, you definitely want to go with itemized deduction, because that would benefit you in terms of what your tax liability would end up in. Also, review your credits. You have to spend some time reviewing any other activity, like in this particular area of the 1040, right? If you see areas of enter credit, ensure that you have a general understanding of what they are and why you qualify for those credits, right? Basically, any other entries in this section is really, it should be understandable, but if in doubt, always ask for clarification. Then we talk about the balance of the 1040, right? Let's confirm the accuracy of your withholding amounts, right? Any estimated tax payments and any refund carryovers. You want to confirm that. You want to make sure it's accurate, right? If you're self-employed, what do you want to do? You want to double check the self-employment tax. You want to make sure that that's calculated correctly. If you're taking earned income credit, the earned income tax credit, if you're taking that, you want to make sure that you've properly filled out the earned income credit schedule, and that is included with your tax return, right? Also, you want to review and you want to confirm any of the entries on the balance of your tax form. If you do a refund, right, you have to ensure your instructions are properly documented on your tax form, all right? Then lastly, sign your tax return. If you don't, it's gonna get rejected. Sign your tax return or your e-file approval form, right? And send the form to the correct address. Without a signature, your e-file cannot be submitted and your tax return is not deemed to be filed. So you always have to sign. Okay, so we have also another thing to make note. This is very important, right? If asking for like a direct deposit of your refund, if you're expecting a refund and you're asking for a direct deposit of that, double check your account numbers. Please double check your account numbers because errors in this particular area, they're hard to correct once your tax return is processed. And you don't want it to take forever because if it's processed that way, the IRS will still send it out to the wrong account number. If it gets rejected by the bank, then only after some time will the IRS now issue you a check, but that will take months. I wouldn't even say weeks at this point in time, I'll just say months. So there are also other forms, right, and schedules. Make sure you review the supporting schedules. You have to. I would say that you should pay special attention to any missing schedules and any new ones that are required for this year's filing, right? Also, as a final suggestion, I'll suggest that you take pull out last year's tax return. Pull out last year's tax return and compare it with this year's tax return, compare it with this year's filing. So that way you need to focus your review, focus it on the areas with significant differences. Okay. Oh, that's it. We're at the end of it. That's the presentation so far. Okay, so I got a couple of questions, and some of the questions I have listed here. And basically, I was asked if I made a profit from Bitcoin this year, but made a loss last year, what is my tax liability, right? Okay, so income from Bitcoin dealings, that gets reported on your Schedule D. Also on your 1040, but this is an additional schedule that you should definitely review before it's filed, right? So Bitcoin is a cryptocurrency, and basically cryptocurrency losses can be used to offset, you can use this loss to offset capital gains, right? But they're subject to certain rules, right? And losses that are not used to offset gains, you can use that to deduct up to $3,000 from other kinds of income, okay? Up to $3,000. This all depends on, let's say, what you bought it as. If Bitcoin, let's say you bought your Bitcoins are bought as an investment, right? And they're sold at a profit. So the treatment of that particular income, it depends on the holding period, right? If you held it for less than a year, or if you held it for more than a year, right? If you held for less than a year, right, the net receipts you basically are treating as an ordinary income. That could possibly be subjected to additional state income taxes, right? But if the holding period is more than a year, it's treated as capital gains, okay? And that can attract an additional about 3.8% tax on net investment income. So basically, to answer this particular question, when it comes to if you made a bit profit from Bitcoin this year, but made a loss last year, what's your tax liability? That really actually depends on you. So basically, your profit from this year, so profit from this year pertains to this year, right? Your loss from last year can be carried over. So you can carry over the loss if it was not applied to let's just say you had maybe 10,000 in losses, right? From Bitcoin last year. And then you were able to only apply 3,000 of it against your regular income. So you still have 7,000 that's carried over to this year. So that 7,000 can be applied against this year's profit. Okay, so that would reduce your tax liability, basically. I hope I answered that question to your satisfaction. So I don't know who had actually asked the question, but if you do have any further questions to this, you can feel free to always reach out to me. I'll be glad to, get back to, respond and let you know, or, you can always reach me by phone. Next question was how much of my rented apartment can be claimed as home office, considering that I worked from home for over 1 year. So this is about 10%. Okay, this would be about 10%. So let's say it's $1,000 that your rent, your utilities, basically $1,000 on a monthly basis. You pay $1,000 a month. You can take 10% of that amount, and that would be your claim for the home office space, right? So that would be $100 a month that you can say these were your expenses for the home office that you can deduct. All right. Keep in mind that you also have to have a dedicated space, though. You have to have a dedicated space to be able to do that. You can't just say, oh, today I'm working from upstairs in my bedroom, while I'm laying in bed. And tomorrow I'm just, I'm outside having a drink with friends. That you can't do. It has to be a dedicated space in your apartment that you can use, and that you can say, this is my workspace, this is my work area, and that's how you can go ahead and claim that deduction. Okay. I am gonna take questions. I'm gonna take questions if there are any.
I have a question.
So okay.
Hello? Hello?
Yes, I'm here. I can hear you.
Yes, my name
Hello?
is, yes, can you hear me?
Yes, I can.
Oh, okay, thank you so much. My name is Julius. Really appreciate the information, highly informative. I have a question around the stimulus check. I am not qualified,
Okay.
but I do have a child that is in college right now that is filing his own independent 2020 taxes. So I want to know if he's going to be able to claim, if he's going to be able to claim the check if he files by himself, and I am not claiming him as a dependent child.
Okay. Yes, he should qualify for the, at least he should qualify for the $1,400 check. Because the rules were changed, because initially, students did not qualify for the checks. If he was a student and he was over the age of 17, he did not qualify for it. But with the new tax law, he definitely would qualify for the new, for the $1,400 stimulus check.
What about the previous ones? I believe it's the 600 and the initial 1,200. That was from last year. Will he be able to claim that?
Correct. Okay, so prior to this, is he a student? Is he working, or is he not working?
It's working partially, but of course, it's still very much my dependent.
Okay.
It's working,
So,
but it's a full-time college student.
Okay. So I know that initially the tax law did not favor students. The first, for the $1,200, they weren't, even going to collect. So I believe even you did not see, they did not give you a stimulus check for him when they did. But you said you didn't qualify for it, right?
Yeah, I didn't qualify. Yeah.
Okay, so then squash that. Okay, so the initial rule was basically, if you were a student, you didn't qualify. If you were a student and you were dependent on your parents, you didn't qualify, right? But if he's filing his tax return, there's a chance that he may qualify for it. I can't speak specifics just because the IRS can come back and say he does not qualify for it at all, except for just the $1,400 based on the law that was recently passed.
Okay.
So I want to say
he would have to file independently to get, I think, wouldn't he have to file independently to get the prior?
Yes. Yeah, he's going to file, but you know how, because of the tax law did not favor them at that point.
Right,
with the
right.
1,200 and the 600. That's the only reason I'm saying that.
If he files as independent, that he's not being claimed by a parent, he can claim that money on his taxes. But if he's
but the problem is he's still a dependent with his dad.
Right.
He's still a dependent under his dad.
But I'm saying that's if hypothetically speaking, if the dad didn't claim him. But if he did, then he would get the 16. But then right,
the 1,200 with a 600.
Plus the 6,
that's
right,
only if his father
18.
doesn't claim it.
Correct.
Yes.
Correct.
So basically, then he will get the 3,200 basically.
Right.
Sorry, everyone. This is Sylvia. She's also a colleague with me. So
I was almost about to boot her off. That are you the main speaker?
I'm sorry.
No, no, please do not boot her off. Do not boot Sylvia off.
Right, that's okay. I suspected.
She's my co-conspirator.
I suspected, but then I'm glad you said something.
Okay, I won't want to consume the time with that question. Maybe I will reach out later and see what is doable and what is not doable.
Okay, so let's just make sure that if you do file your taxes, you cannot list him as your dependent at all. You cannot, because once you claim him, even if he files, once you claim him, even if he files, he will not qualify.
Okay, I haven't filed, so that's why I'm holding out until I have the full clarification. So I'll wait on that. Okay. Thank you so much. Yeah.
You're welcome.
All right, if you're asking a question, introduce yourself, also see where you're calling from. And so, anybody? Well, Bose, I don't know if you can see there are some questions within the chat. I don't know if you can see those ones. Okay, are you able to see them?
No,
Then
give me 1 second.
Okay, I can read them out if you.
Okay, I can see them.
Okay, all right.
What it was for a conference out of country. I'm not sure if this is I don't understand this question because Cyril Ikechi, sorry, and if I mispronounce, I apologize.
Cyril,
You're saying that's strange. What if it was for a conference out of the country? Can you claim it?
Yes. So hi,
I'm not sure what you're talking about in reference to this.
So this is Cyril. So most times we probably have like conferences for medical staff or medical personnel, and we could go to a conference in any country at all. Can we claim that as on our taxes as an expense, like travel expenses for like medical conference and stuff? That's what I meant on that question.
Yeah. But I think you must have gotten online when we were talking about my own personal,
yes.
As to the reason why I cannot claim that. Because
yes.
I guess I was talking about the reason why I can't claim it because I did not come here on a business, it was not for a business trip. I came for personal reasons. So that's why I couldn't claim. I guess that's why you were saying that's strange, because I was like, what's that? Okay. So what if it was for a conference out of the country? Can you claim? Yes, it's an expense. You can definitely claim that. But usually with medical conferences, I would expect, your company, the job or the hospital, depending on who you work for, your employer, to actually be the one paying for the expenses, unless, you're maybe a private contractor. But either way, anything related to businesses is definitely deductible. You can definitely claim that. Just make sure you have all your receipts. You have to always keep your receipts.
Okay.
Okay.
So if you're an independent contractor, you could always claim that on your taxes, correct?
Yes, that's correct. Yes.
Okay.
If you have an expense that's related to business, you can always claim it. But always just make sure that you keep your receipts, because if ever the IRS was to come after you, you want to show proof. If you're using your credit card, keep your statements, all that stuff, save it, save your documents. I know some people are always quick to shred, but my suggestion would always be to, scan your receipts. If you know that it's something you can easily lose, scan your receipts and save them on your computer or save them on a hard drive. Just, save them. Save them on a flash drive or something. Just always save them. It's always better that way. Okay, so next question. What are the benefits of a married filing separate? I'm sorry, Sarah?
I had a follow-up question. No,
yes.
I had a follow-up question. I know I sent it in the chat to you.
Yes, I was reading
for startup, right? LegalZoom to open an LLC S corp. Would that be advisable, or you need to go through a CPA for you to open one?
So I would say that it's really up to you. I mean, you have to determine, like, LegalZoom has its own, like this setup. That would be for you to do research and say yay or nay. Is it always better because you're not really seeing the person, you're not really, these are different people that would be picking up your calls. So basically, it really is up to you if you want to, go to LegalZoom, and basically they, once you fill out the information, and then I know that their process takes, I believe it takes maybe a couple of weeks or maybe within days. It's the same with every other, tax preparer, every other accounting firm, basically. But is it a good place to open an LLC? I don't know. I honestly can't say, because sorry, I don't work for LegalZoom. I can only say to you that it's always better for you to either go to an accounting firm or a law firm, and ask for, and set up an LLC that way. I can't speak on LegalZoom as a, but I know that people have used it. A lot of people have used it, but I can't speak to it.
Thank you.
I hope, I'm sorry, I know that doesn't answer your question, but I would think that, you can always read the reviews and stuff like that to determine if it's suitable, if it works for you personally. Okay.
Thank you.
Okay. I know you also had another question about what are the benefits of married filing separately, even though we live together and have a business together. There are no benefits. You miss out on all the credits, all the benefits that you could have if you're married filing jointly. You lose that when you marry filing separately. So let's assume you own a rental property, for instance, right? If you file separately, and you're able to deduct rental properties, you're able to deduct $25,000 in losses, right? If you were single, or if you were married filing jointly, or if you're a head of household. But if you are married filing separately, you lose that. It drops from $25,000 to $12,500. So those are instances of some benefits that you end up losing. So I always suggest to people, if you're married, file jointly. I know some people file separately because of their income. Maybe one spouse is making more than the other, and they don't want to pay the other person's taxes. So I've had situations like that where couples will come in and say, no, I don't want to file with my husband. I want to get my refund, and then when he files, he has to pay taxes back. You have to, I would suggest to people, it's better for you to file jointly, because then you don't lose out on the credits that you could get. Okay. And plus, if you also have a business together, you're filing a Schedule C, or is this an LLC? Schedule C is under the 1040, by the way. Okay. Okay, so when I say LLC, is it a sole proprietorship? Was it set up as a partnership, or was it set up? How was it set up as? If it's an LLC.
It will be set up as a sole proprietorship.
It's going to be set up as a sole proprietorship. So that means that it has to be filed on a 1040 Schedule C. Okay, so it has to be filed on a 1040 Schedule C if it's a sole proprietorship. My advice would be to file jointly and not separately if you're filing, especially because you don't also want to lose out on the benefits that you could get if you're filing married jointly. I mean, and it also would determine if you have kids as well, you don't want to lose out on certain credits as well. So it's always best to file jointly.
Okay, thank you.
You're very welcome.
Yeah, thank you for making that point. So bottom line is that when you are filing taxes, when you have an option to file jointly, it is the best option to take, right? Is that, I just joined, so that is what I made.
Correct.
Thank you.
That's correct.
Uncle Sheson, you should introduce yourself.
That is correct.
Also, I'm so sorry. My name
Cyril, you did not introduce yourself. You just kept asking question after question.
I'm sorry, I just joined about 3 minutes.
That's okay. No, not you, Sheson. I was talking to Cyril also, but Sheson, introduce yourself, and then let Cyril introduce himself before Bose goes on with the next one.
Okay. So hello, everybody. My name is Sheson Ogunshakin. What can I say? I live and work. I have a family. We live in New Jersey. I work and I also own business, and I'm glad to be here. What else can I say?
That's all. That's okay. Thank you. Welcome.
Thank you.
All right, Cyril.
Okay, so my name is Cyril Ikechi. I live and work in New York City as well. I'm looking to start a small business, me and my wife. So that's I think that should be all.
Right. Thank you. Also, you can go on with the next question. So whoever joins now, if you want to ask a question, please introduce yourself. Also tell us where you are, where you are asking the question from. I think that should be enough. Well, tell us if you're an ex-jam or you're a friend of an ex-jam. Yes, Bose, go on. Thank you.
Okay. So the next question is, can my US citizen son living in Canada, who's currently 20, qualify for the stimulus check if he files this year? And the answer would be yes. Even if you're out of the country, as long as you're a U.S. citizen, you do qualify to get the stimulus checks.
Can I ask a question?
Does that answer your question?
Yes, it does, Bose. Thank you very much.
Yes, please, go ahead.
We'll be seeing you offline to collect that money.
Sorry,
Okay.
one question here. I mean, I do have something that I've really been, that I didn't want to, I'm glad that Kayode set this up so that we could talk to, you know, a specialist like yourself. What is the risk in, if you own a business, let's say LLC, you know, what is the risk of filing Schedule C, you know, claiming that your business is, you are filing Schedule C with the business that you own, and at the same time, that business is generating, you know, you're doing, what do you call it, pass down, what is that word? You know, there's a word that is used in accounting, where if you have an LLC, the business doesn't really pay tax, but you pass down both the income and the loss of the business down.
That's true.
Pass through. Thank you. That is the word I wanted to use. So what is the risk in trying to operate, you know, by filing a Schedule C in your personal tax, while at the same, you know, through for a business that you own? You understand my point? I mean, do I make myself?
There is really no risk. I mean, as long as you file your tax return and it's accurate, there is really no risk. I mean, and you, I mean, is it a sole proprietorship? Is that why you're filing it a Schedule C?
Yeah, no, I'm talking about you have an L, because I think one of the rules that somebody made me understand is that if you own a business, it's difficult to convince IRS, you know, in the eyes of IRS that because when you are filing Schedule C, that is like you are claiming as a contractor. You can't be a contractor for a business that you own. Am I making a point here?
Yes.
So
you're the owner.
You're the owner, so you can't be a contractor. You can't. It's risky is claiming that the business is you're a contractor for the business. So that is the point I'm trying to clarify, that if you own a business, what is the risk? You know, no, it's not even a matter of risk. What is it possible to at the same time claim that you're a contractor with the business? That is the business issuing you a 1099 MIC, for example. You know, and at the same time, you know, I mean,
okay.
the profit and the loss from that business will see pass through you. You know, it's like a double-edged sword. You are claiming that you're a contractor at the same time, you know, under normal circumstances, when you file your taxes, there has to be a pass-through section at the same time. So can those two coexist, or it has to be one or the other?
Okay, so if I'm understanding you correctly, you are, okay, so you own the company, you own this business of yours.
Yes.
And then you have, you're issuing yourself a 1099 as well?
No, I'm thinking, no, I don't, I've not been doing that. I'm thinking of, should I do it or not, you know? But I feel, based on some little research I've done, that one should not do that.
No, you shouldn't.
Okay, thank you.
You're the owner, so you should pay yourself a salary. You know, you should have, you should, you know, set up payroll, and, you know, you could be an employee of the company that you work for, but of the company that you own, but you can't be a contractor. You know, it's your company.
Yeah, this is
so no, you can't be a contractor.
Yeah, thank you so much.
Okay.
Just a question just pops in my mind based off of that. Can you be a contractor for your wife's company, you know, for your spouse's company?
Can you be a contractor for your spouse?
Yes,
Is that what you just said?
Exactly,
okay.
Exactly. I know since you said you can't be for yourself, right? But
well, if it's her business, Yes,
Mhm.
but you can't, you are not on it at all as a
As long
business
as,
owner.
as long as
Your
you're
name,
not, yeah. As long as you're not in that business as a co-owner, yes, you should be able to do that.
All right, thank you.
What do you do to this Yoruba?
Yes, no, you can't say that. The whole of my old school students are on this call.
Sorry, I'm
Yourself off your mic, Senator.
Kayode, I have another question though.
Go on.
This is serious.
Sure, go on.
So my question would be, how many of my children, if I own a business, that I can have on payroll? And what is the maximum deduction that I could pay each of them? And for how long? Thank you.
there is an, okay, so I forget exactly what the amount is. I can get back to you on that. I don't want to tell you specifics and say this is exactly the amount but you can definitely have your kids on your payroll as long as they're of legal age. You know, you can't have a 1-year-old on your payroll. Okay, so it depends on the age of the child. Can they do the work that you're claiming that they're doing? You know, but at the same time, I have to check, because there is some benefits to that, to actually having your child on your payroll, because then it reduces your expense, number one. So you know how when you send your kid, okay, take out the trash, I'm gonna give you like $20. That's if let's assume you're working from home now, and the trash, well, that's in your office space basically right now. You're paying that child. There's some certain things, especially if it's a business that you own, you can definitely use that to your advantage. But I definitely will get back to you on that question. If there's any way that can be emailed to me, I can definitely respond to you and provide you with more details. I don't want to give you more specifics and I give you incorrect information. I'd hate to do that. So if you can, I will definitely get back to you. So just shoot me an email to info@bosetax.com. I don't know if you can see it down here on the screen, info@bosetax.com, or even to bosede@bosetax.com, and I'll definitely respond to you. Okay.
Thank you.
I have a question. So my name is Monica, and I live in Houston, and thanks, Bosede, for taking the time to talk to us. So my question is, you just said something about working from home. What can we claim in our taxes now that we have people working from home? What can they add? What can they claim as part of expenses?
Okay, so basically, if you had to maybe get a printer, you can claim that. If certain expenses you can claim if it's related to you setting up the office space in your home. All right, but then again, keep in mind, if you also have a dedicated office space, you can claim up to about 10% of that. So let's assume maybe like with your rent, utilities, let's say it's $1,000 a month, you can claim $100 a month in that. Okay, so that's something in addition to that, right? Some employers I know are giving back, paying their employees for certain expenses. If your employer did not reimburse you, then you should be able to claim for, but mostly depending on the state you're in, your employer should have either provided you, maybe if you're in like California, New York, a few states basically, then your employer should have actually provided you with your printer, your laptop, phone, certain things like that. If you're in a different state, you should be able to claim that on your tax return as an expense.
Thank you.
Like the chair you're sitting on to do your work. If you had to, like purchase that, for your work, purchase a laptop to do your work from home, purchase a table to do your work from home. Certain things you can claim. A printer, for instance, because depending on the nature of your work, if you have to print a lot of documents, stuff like that, you can definitely claim that.
Okay, thanks.
What of the coffee you drink while you're working?
Oh my God, Coyote.
What? You don't want to claim your coffee?
Okay,
I
no,
drink a lot of coffee. You can't claim it?
no,
Oh, okay.
no, I'm sorry.
Okay.
You can't just claim anything. You don't want them to come after you.
But I drink coffee while I'm working. Okay, all right, that's fine. If I can't claim it, that's it.
Yes, but
Question.
usually don't you, I mean, I get it. Some companies do provide you with, coffee if you were in the office, but that's if you were in the office, right? So now you're working from home. It's a different ball game. You're already at home. So if you were drinking coffee in the office, you were most likely drinking coffee at home before you went to the office anyways, or you were either buying it on the way to your office. So the IRS changed their rules, and they changed their rules, and they changed it because they didn't want, like certain expenses are no longer deductible compared to the past where you could have deducted your meal expenses. Certain expenses are not deductible anymore. You could thank your, ex-president for that. That's all I got to say about that. He changed a lot of rules. Yeah. So, okay.
I have a question. Bose.
Anyways, that's.
Yeah. My name is Jason. I have a question.
Okay.
Can you claim taxes? Can you claim something off you like you're working from home, like in your basement, and at the same time use your business as well to claim? Like
I'm sorry.
I've converted my basement to an office, right? For my business. However, I still work off it from home myself. So can you claim on both sides?
Okay, so you work from your current office?
No, I work off my basement from my business office.
Okay, so you work.
Business, right?
You have a business.
Yes.
Okay.
And I do work from my job, my regular job that pays me. I work from that same basement. Can my business claim? I sure do claim too. Like you rightfully said,
You
I
can
have
double dip.
my office there. The business is just started.
You can double dip. So even if, okay, so if your business just started this year, right?
Last year,
but you were working from home last year?
Yes.
Okay, so you can still claim that workspace for your, with your, as an expense. You can, but that's 10%. And so let's say it's your own home. So basically it would be your mortgage expenses, right? It would be your mortgage and your utility.
Right?
I'm sorry?
10% of my mortgage.
So basically it'll be 10% of your mortgage expense and your utilities, yes, that you can claim.
This is good news. Thank you.
You're very welcome.
Yeah, I have a question. So this is Ayo Adams from Canada. Well, thank you so much for this wonderful presentation. I actually have two questions. So the first is, if I typically file with my spouse, but if she's out of the country, and if I need to file and list international income, what impact will that have on my tax credit? Will that be beneficial or not? So that's the first. And then the second is, if I do have a liquidated business from the previous year, how would that impact, how would that offset capital gain? What impact will that have to my tax credit if I were to list that in my filing?
First of all, you have to list it in your filings. Okay, so your first question, let's start with your first question, right? Your wife lives abroad, right? And she works abroad as well, right? Okay, right. So if you're filing a joint return because she's in the, but you're in Canada, so you're filing a Canadian return, right?
Right.
Oh yeah. So I can't speak to that, just so you know, because
no. So absolutely, but I understand that there's some commonalities to some of these things. Of course, it's not to the specifics, but the commonality.
Okay, but I wouldn't want to mislead you. Okay, all right. So there's always foreign earned income tax credit, right? You will include her income. If she's paid taxes on that income that she earned overseas, then that's also reported there, and then you can get that credit taken, you know, that credit will be deducted off of your liability, that sort of thing. But again, I'm going to say, I don't know how Canadian tax works. So I've never looked at it before. So I don't want you to base my response on Canadian tax return. Everything I'm speaking about is in, you know, US tax return and US tax return only. So I just want to make sure that you're, you know, that we're 100% clear on that, because I don't want you to say, oh, Bose gave me wrong information, you know, but I would hate to do that. I mean, I can always look it up for you, you know, just to make sure that there's no differences between Canadian and American. I'm okay with doing that for you. So if you want to do me a favor, shoot me an email with your question again, and I can definitely look at it and say, oh, you know, and review what Canada's tax laws are. And, you know, I can definitely do that. I have no problem doing that. So I will invite you to just shoot me an email, let me know, you know, and I'll get back to you. Like, I'll respond to you. Definitely not tomorrow, because that's Sunday. So any responses you get will start from Monday onwards. Okay, just so we clarify that.
Yeah, I appreciate that. I was going to say Bose said that anyways, but thank you for clarifying.
No, I just, you know, just so, you know, just because it's just better. So, yeah.
Yeah.
And we are going to make your contact details, your business contact details available for everybody on the presentation that might have follow-up questions. So if a question is going too much into you know, something that needs clarification later on, just let the person know, and then later on they can reach out to you.
Okay.
All right.
Sounds good.
Mira, dice golf, G-O.
Yeah, I think
so.
If you still have more time for one other question, I will appreciate it. This is Cyril. I'm trying to pay as less as possible as Trump. So that's why I'm asking all these questions, because, you know, we're trying to pay less tax as possible. So my question would be, if you own a business and you go out for lunch or dinner, can you put that in as a business lunch or dinner and claim that on your taxes as much as you can? Or let's say, for example, I go out for dinner every Friday, once a week. Can that be claimed in my taxes as well?
Is that a business expense, or is that personal? This sounds like as if you're going on you're taking your wife out on a date. It's every Friday.
Well, can that be a business dinner? Because we're both business personnel. So can we claim that on our taxes as business dinner if we invite a friend or two out as well?
You said a friend. It's not even a business partner. It's not even an investor. No, I'm sorry. Just based on what you just said was a friend. No, I'm sorry. I have to just let you know that no, you can't claim that. The tax laws changed. Before you could have claimed. I'm sorry, you're breaking up.
So sorry about that. I'm actually driving. So let's say a colleague of mine or a colleague of ours, we are both physicians, right? So we have colleagues that if we decide to go out on a dinner or lunch and we discuss medical problems during that dinner or lunch, can we claim that in our taxes?
I spin.
How long will you just? Yeah, I think you just wanted to duck.
Probably like for an hour or two, because most times when we go out, like we spend an hour, 2 hours on a lunch or actually dinner. So can that be claimed on taxes? Because from my understanding is that you can claim those on your taxes as long as, you know, if it's a business dinner, and business could be you discussing a case over lunch or over dinner. So would that be ideal?
That's correct, but you said initially that you were going to invite friends. You know, you can't. It has to be specifically for business. It has to there has to be a goal. Any business, if you're taking a client out to dinner, or if you're talking about business, just specific. You know what I mean? It has to be for a business. It has to be, there's got to be where you're trying to get to. You can't just say, I just want to, let's just go out. We'll claim it on our tax return. We'll claim it as a business expense. Well, let's go out, let's drink, let's eat, let's have some fun. And once we're done doing that, let's dance the night away. No, that won't work. There's been a lot of changes to the rules lately. So if you're going to have a business dinner, it has to be specifically a business dinner. And you would want to keep the receipts, and you would want to write down details of what that conversation was about. It just can't be. The only reason why I say this is because there'll come a time, and I sure do hope that nobody gets audited. But when that time comes, the IRS will definitely ask you to submit proof. They'll ask for proof. What if you're telling me that, and you can't claim all your business meals anymore. It's not going to be 100% that goes to, it's a certain percentage of business meals that you can claim. So I'm just gonna say this to you. If it's for business, if you always keep track of whatever your expenses are, and always make notes of what discussion transpired on that day for that meeting. Like keeping the minutes or something, just because you never know when you're going to get audited, and it could be 7, like whatever years down the road, 2 years, 3 years down the road. And the IRS will say, where's your proof? And then if it's a business, they'll say, well, you should have this log. There should be some sort of, something in your system that you can provide us to say, this is what it was for. So you always want to, be able to show proof of whatever transactions you do have. That's
so. Just
all I'm gonna say about that.
Just so I understand, if it's a business lunch or dinner, there should always be a minute, and there should be a log. Is just for proof?
So I'm just saying that just basically because if you ever get audited, you want to have proof. I'm not saying that there should always be. I'm just saying that if you weren't doing that before and you started taking it now, if the IRS comes after you, they would want to see proof.
Okay.
Because now, keep in mind that a lot of people are doing a lot of, let's say, shady things, right? To try to get some sort of like previous tax return and compare, another tax return and say, wait a second, when did this start? So they may sit down and say, oh, we're going to audit this person. That's the only reason why I'm suggesting to you that you keep receipts and you document. You could always make a note. That's why I said it's easier for people when they, if you get a receipt, if you go out, if it's just you and a coworker, or you and a client, you make notes. You have just a little bit of a note. You don't have to, have a big file of it, but just something where you can go, oh no, this is what this for. Yes, we met to discuss this. Yes, because whenever you do get audited, that may come back to bite you if you can't prove it. Because the tax examiner, whoever you're meeting with, will definitely take that out. They won't want you to. The goal of an audit, especially with the IRS, is if they do audit you, they don't want you, to prove them, wrong. They want to be right. So their goal is to tax you more, to get you to pay. Your goal is to make sure that you're not paying them a dime. So hence the reason why I'm suggesting that it's always good for anything you do when it comes to your returns, always have a receipt. If you're, let's say, for instance, you are donating like clothing, shoes, whatever it is to a charity, keep your receipts. If you're going based on fair market value, which we know that a lot of people like to increase the value even though it's not what it is. So you have to prove it. You have to, if you did donate 20 bags of shoes and clothing, prove it, just prove it. Make sure that receipt states that. Make sure, it states the value as well on that receipt. So that way, this is your proof to show to the IRS. You don't want to come a time, because most charities would just give you a blank sheet of paper and then you go and write it. Okay, you don't want that. You want real, documentation to prove that this is how you came up with that fair market value. And usually, because when clients come to me and then they provide me with receipts, it's like, okay, show me what exactly did you contribute. Then we now go in and pick up like fair market value based on what that product is, what that item is that was donated. I know I'm off the track here, but I'm just giving you an example. Certain things like that. It's always good to show proof. Okay.
All right.
Thank you.
Can I ask you a question? Just to follow up on what Cyril said. Like I said, our business started last year. We didn't open an account until like late last year. We've been working off our credit card to grow the business or to put things into the business, right? Definitely, we have to lobby some people to come in for us. We've been taking them down for lunch, breakfast, and dinner without receipt, but it's on our credit card. Can we print those receipts out and use that for this year? Because this is our first filing with the business. Can we do that? Hello? Can you hear me?
There's a lag.
I didn't hear I did not get your entire question because you were kind of breaking in and out.
All right, let me
but as long as, I'm just gonna say this, as long as you do have receipts.
Even off our personal credit card, not the business card. If it's our personal cards, we can still use those. See, what's the head money? She ran away.
So what he's saying is that if those expenses are made through their personal credit card, can that still be presented as an expense for the business?
Yeah.
Exactly.
Benu, right? Maybe you should type that also in the chat, so that when I think she probably logged out so that she can log back in.
Okay.
And then because it's Nigeria, sometimes there's a lag before your comment gets.
Okay,
no, I don't think so. Because how are you going to prove that it's a business expense? You have to use your business credit card.
Well, prior to you opening your business, though, or opening an account for your business, there should be a way you have to expense the business, right?
Well, one of the first things you do when you want to open a business is to have a business account.
Not necessarily,
Hello.
I think. Oh, I'm sorry. Go ahead.
Okay. You can actually. A lot of people have done that. You can, start a business and use your personal account. But you have to provide receipts. You have to keep track of what's business and what's personal. But always the advice, like I said in the beginning, it's always better for you to set up your business. You always have to separate it once you start. Okay. So I know that a lot of people, when they start initially, they don't have that fund, right? It's they don't have that money. So to set up a business, to set up an LLC, you have to pay out of pocket for that and stuff, whatnot. Your main goal is just, let me get this business running. Let me make some money, right? At the end of the day, you're using your personal account for that, right? My suggestion always is, set up an LLC, set up a business account, and then, make sure your expenses are coming out of your business account. But if you've been using your personal account initially, you can still claim that is still expenses that you can still claim that's still deductible from your business, from the business side of things. So yes, you can use that too as your business. I hope that answers your question. Yes. I didn't get the entire piece before I got kicked off for a second there.
That's fine. Thank you.
But yeah.
So, Bose, this is me again. I'm sorry. I have so many questions and so many clarifications. I know this.
So
go ahead. I'm
sorry. I'm sorry. Okay, so I'm gonna say I will take this as the last question, just because if you can bear with me, I'd rather you guys just send me questions. You can always email me. Feel free. Email me anytime. I'll respond to your emails. It's just because I know that it's good. I mean 5 hours time difference, so I apologize. It's 9:40 over here. Just because I decided to take a road trip, but I'm sorry.
I'm sorry.
But I will, if you don't mind, I could take one more question, and please. Okay. Yeah, they're always fun.
So are you are you operating out of Nigeria or you are based in the US and are you still taking clients?
No, I am based in the United States. I am based in Jersey. I live in Jersey. So I came here for family. I lost my father-in-law. So after that, we flew down here. And then I decided it was better for me to stay here than for me to be, in the States where it's cold. So hence the reason why right now I'm working from here. I intend to stay here for as long as I can because I do have a secure portal. So all my clients are able to contact me via phone, I'm roaming my phone here and they're able to get me at any time. So I'm okay. Yeah, sorry. I'm going to stay here for a little while longer. Okay. But if you do have any questions, please, by all means, call me, WhatsApp me, email me, check out my website, bosetax.com. You're welcome to do so. Even if you have questions like on your LLC, S Corp, all of that is actually explained on the website as well. So if you wanted to even get more information, just really go on my website. I do have a lot of, questions, answers that I have on there. So, but if you've checked it out and you still have questions, please, by all means, feel free, email me. I'll definitely be glad to answer your questions.
Thank you.
Okay.
All right, thank you. One last question.
Thank you so much.
I got to give over to you, sir.
All right. I thought Goldme was saying one last question. Goldme, were you trying to ask a question?
Yeah, I got my questions on the chat.
Oh, okay. Just ask now since.
All right. Thank you, madam, for your time. My question is, so trading on the stock market, we record like short, small gains. How do we put that out? Is it still capital gains on your filing? Like if you make money off the stock market in less than a year, like you're holding it for just swing trades. Yeah.
Yeah, that is, but then, okay, so keep in mind, if it's short term, you're paying more in taxes, okay? Excuse me, that's still gonna be filed on your Schedule D, but you're paying more in taxes compared to if it was long term, then you pay lesser taxes. So you could be paying based on, being that it's long term, it's short term, you could be paying up to 35% on your gains. If it's long term, you could be paying anywhere from 0 to 20%. It depends on your income. So just keep that in mind. So, but yes, that will be filed on Schedule D and you're definitely subject to taxes. And I'm sure the IRS will love you for that.
I have one question.
Thank you.
Around the area of trading, right? Stock market. So say you have Amazon, you've held it for over a year, right? And so that falls into the capital gains, right? Now you decide to buy.
It's long term, yes.
Yes,
it's no longer ordinary income.
Let's say you decide to buy 10 more of Amazon at the beginning of this year, and you sell that 10, or within the year. How does that work out? Is it considered? Can I say that was the 10 of last year? How does that? How does that play out, basically? Do I make sense? So I've had Amazon for over a year.
No, yes,
and then I did the equivalent of a short-term trade within that same Amazon, which is like adding more and then selling it off. How will it be considered? Will it be capital gains?
Yes, no, it could be considered. It could be considered capital gains. It just okay. So if there is, obviously you made a profit, right? Because it's obviously you made a profit, right? Yeah. If you didn't make a profit, we won't be talking about this.
Yeah.
So it could be considered capital gains. Yes.
Okay. All right. Then the other one is because I was so scared of IRS audits, I reported gains 1 year, but when I made a loss, I couldn't find anywhere to report it. Now, is it still possible to adjust things I reported before?
It depends on how far back that is. So you can amend right now, you can amend at least your 2018 tax return, 2019. So it depends on how far back that is. You can't amend 2015, 2016 if it goes that far back, because you can only amend within 3 years. Only if the IRS were to come after you, but then they won't even let you, put that on the list because it's a loss. They don't want you to deduct that anymore.
Exactly.
But you can always carry losses forward.
Oh, for how long?
Is it 7 years? I want to say 7 years. I'm sorry. Sometimes I want to say 7 years, but I have to confirm that. I'll confirm that with you, but you can carry that forward.
Okay, that's fine. All right. Any final comments? I want to allow Bose to go and sleep.
We just want to say thank you so much. It's been
no, it's not to sleep. It's just to go see my 3-year-old.
I know. I'm sorry for the loss.
All right. Any other comments? Thank you, Julius.
I'll just echo Julius's words. We really want to thank you so much for making the time, to share your wealth of experience on this topic. So very much appreciated. Thank you.
Yeah, same thing here. Thank you so much.
Thank you for having me. It's definitely been fun. Thank you so much. I do appreciate the time that you guys allowed me to speak to you. So I do appreciate this. Thank you. And
so
have a good
on
one.
behalf of
I will be seeing you, talking to you later.
Airmen, on behalf of all the ex-junior airmen in the US and in Canada, I am thanking you on behalf of all of us for the, I always make this mistake, I get into trouble later on, and all the ex-junior air women in the US and Canada also. I am thanking you for the time that you've taken out of your busy schedule to share all this knowledge. It's been very helpful. It's educated us a lot more, and I'm sure that there are many other people that will want to contact you to basically ask more questions. So thank you very much. We really, really appreciate the fact that you were able to do this for us.
All right.
Yeah. All right, so now I'll leave the bridge open